I know you like to look at historical trends. And so when you look at a bull market run like we've had, whether you want to look over the long run or even just look at 2019, what could that possibly portend for 2020? Can we continue from here, even though the market is pretty expensive?
I think we can continue, and I think typically good years tend to follow great years. One of the things I like to look at is what kind of dispersion was there between the best performing sector and the worst performing sector in the prior calendar year. And whenever we have had a below average differential between those two, the S&P gained an average of a little more than 13% in the coming calendar year, and the frequency of advance was very, very high. So that sort of implies that, like a compressed spring, that we tend to bounce in the following year.
Is your positivity based, though, mainly on that backward-looking assessment or forward-looking factors? What are you focused on, and what needs to arrive, whether it's in terms of the Fed or earnings growth, to justify a bullish stance?
Well, I look to history. It's a great guide, but like the singer of the national anthem, sometimes it forgets the words. So what I do is I overlay our economic outlook, fundamental forecasts, et cetera, to then say, could history repeat itself? Right now, I think that prices are leading fundamentals. We're only looking at a 7.8% gain in earnings for all of 2020, but I think the market is saying, look, if we're wrong, we're probably underestimating economic growth and earnings increases rather than overestimating them.
We were worried last year about an earnings recession, which didn't happen, but it wasn't robust earnings growth still. We saw the S&P gain 28%. So do you really need robust earnings growth to see this market continue to push forward?
Well, because the market tends to look 6 to 12 months down the road, and it knew that we ended up with a 23% increase in earnings in 2018, twice the amount that was anticipated at the beginning of the year. So when you have a bar that high, it's very hard to eclipse that. So that's why we're looking to be up only about 0.5% for all of 2019. So 2020, yeah, the expectation is for an improvement in earnings. Valuations right now are looking a bit stretched, anywhere from 9 to about 12% overvalued, but that could easily be digested either in time or a pullback in prices.
Paul, what's your take in terms of the valuation outlook? Do you think it's justified because of where rates are?
Well, so rates are low right now, so that does justify lower rates. But the thing about valuations, it's what we always say, is they're a horrendous timing tool for the market. Valuations, if you try and sell when valuations start reaching a certain level, you're going to miss the strongest parts of rallies. When the S&P PE ratio goes over 20, their returns are positive going forward. And in the 10 years where valuation, the S&P 500's PE ratio has been close to the 5 years above and 5 years below to this year, we were up all 10 years the next year. So I think the big question is, we talk about interest rates, and the question is, if everyone's expecting interest rates to stay around 2% right now, what happens if we do see rates go up to the high 2% or even just a shade under 3%? Will the market be able to handle that?